Hello and welcome, What the Finances, to another episode of the What the Finance podcast, where we talk to experts to help gain a greater understanding about what is happening in the world of finance, investing, and markets and macro as well. So, on today's podcast, I'm happy to welcome Sri Prakash, who's the host of Market Champions and is an up and coming macro expert who's still studying and he's probably knows more about macro than 99.99% of the population and other investment experts. So, Sri, thanks for joining the podcast today.
Thanks for having me on, Anthony. It's awesome to have you. It's awesome to be on.
That's the because you're used to being the host, eh?
Yeah, so I feel it's gonna be fun being on the other side of the podcast. So typically, running Market Champions. I'm on your side, so I'm the host, and so now it's gonna be me as the guest. So it's gonna be fun.
Yeah, you can talk rather than listening the whole time. Actually, get your opinions across. So, yeah. I guess my first question. Over the past few weeks, it seems as if everyone's been talking about a recession. It's sort of the favorite word of everyone at the moment. The White House is they've gone as far as to officially change, maybe the technical definition of a recession, and other people have followed. So, I know you've done an interview recently. I think it's on the Boiler Room about a recession. Your opinions on the potential for a recession. So, what do you think's happening? Are the White House right, or do you think we are in a recession at the moment?
So I think what's interesting is when it comes to the definition of a recession, so officially speaking, the U.S. is only in a recession when the NBER, the National Bureau of Economic Research, declares that the U.S. is in a recession. So I guess that there are several economic textbooks that suggest that a recession is when there's two consecutive quarters of negative GDP growth. But broadly, we're only in a recession when the NBER says so. But what I think is interesting is we're definitely in some sort of an economic slowdown, and a lot of that is indicated by just the broad GDP numbers, a lot of the economic data. So if you take, for example, some of the PMIs that came out recently, so you can see that manufacturing, broadly speaking, has entered some sort of a slowdown. You're also seeing stuff like orders to inventory numbers go down. So as I mentioned when I was on the Boiler Room podcast on Blockworks, so the thing about the orders to inventory numbers, it's a pretty good indicator of demand. And so what we're seeing is we're seeing inventories build up. So companies are not able to get the stuff off their shelves as fast as they could previously. And the other interesting thing is, so if you go look at the Fed survey, so the various Feds conduct manufacturing surveys once a month, and they publish these results as a report, and they come out once a month. And so, for example, if you take the Empire State Survey, the one from the NY Fed, it sort of shows that the expectations of a lot of these manufacturing companies and what's going to happen in the future with regards to orders is that they're expecting some sort of a slowdown. They're expecting some sort of demand for their goods to slow down, and they're expecting prices paid to come down. They're expecting their supply chain bottlenecks to ease, and where it becomes interesting is, so if you look at the yield curve, so the yield curve has been, broadly speaking, a very good predictor of recessionary conditions. The timing can be off, but it has helped predict when the economy goes into a recession. And one of the interesting ones was prior to COVID, it inverted, and I think about 12-ish months, 12 or 18 months, somewhere between there, 12 to 18 months later, we ended up actually getting a recession. Obviously, it's hard to argue that it predicted COVID, but it definitely did help predict some sort of a recession. And so I think that's where it becomes interesting, is a lot of these macro factors, a lot of this macro data seems to be pointing to, at the very least, some sort of an economic soft spot or an economic slowdown, or at the very worst, some sort of a recession.
Yeah, and that's it'll be interesting to see what happens. And one thing that I've seen is there's almost seems to be mixed signals coming from macro and indicators. So you mentioned there that inventories are growing. Some companies have experienced reduced sales. Walmart's having issues. For example, and other companies as well. Whereas we see Visa, Mastercard, American Express, they're saying the opposite. They're saying spending is growing. People aren't slowing down. So I guess why do you think we're seeing such a difference between these different indicators?
I think that's an interesting question. So I think one thing that's worth looking at is, so when it comes to the demand on the consumer side, so that has had an impact when it comes to when it comes to the inflation that we're seeing. So I would argue that a lot of it is definitely caused by the various supply chain disruptions, along with the higher prices in energy and food. Some part of that has been aggravated by the conflict in Ukraine. But if you take a look at personal consumption expenditures, so what we have seen is, if you look at the trend of personal consumption expenditures prior to the pandemic, so it's say from 2009 all the way to March 2020, so just before the pandemic, we saw the trend now, or personal consumption expenditures now are far above the trend that they were on prior to the pandemic. So what we're really seeing is some amount of elevated spending when it comes to personal consumption. And a lot of this, at least throughout the pandemic, has been in durable goods. So say, for example, washing machines or televisions, etc. And the interesting characteristic about these kind of goods is that when you take a durable good, it ends up being a one-time purchase that you end up not replacing for, say, the next 5 to 10 years. If you buy a washing machine today, you're likely not going to replace that for the next 5 to 10 years unless you run into some sort of difficulty in operating, or it runs into some sort of problem. But broadly, so that's been one. And then the other important factor has been, to an extent, a pent-up demand type dynamic, and also seeing what wage growth is doing. So wage growth, which is largely been concentrated around the low end of the employment spectrum. So the people who used to earn less, you're seeing a higher level of wage growth there, and so that has definitely contributed to some level of spending. But you can really see that when it comes to your core PCE or your core CPI. So this sort of excludes broadly the energy and the food impacts, which are largely concentrated around supply issues and the war. So when you take the core CPI numbers, we're starting to sort of see that roll over, and to an extent, we're starting to see the PCE numbers start to roll over as well. And what I think is also interesting is, so if you take personal savings as a percent of disposable personal income within the US, we're starting to see that decline quite a bit. And I think that's significant just because so as soon as the pandemic started, we saw a massive rise in the savings rate. And so the savings rate was at about 35%. And now it's down to about 5-ish%. And so I think those are some of the dynamics that are driving consumer demand. I just don't know how long that sort of thing is going to last. And so, to an extent, higher interest rates will have their impact on the sort of consumption when it comes to consumer demand. But a lot of the impact of higher interest rates, what we're seeing is within, say, for example, manufacturing and on the corporate side. So we're seeing a lot of signs of slowdown in manufacturing. So take a manufacturing employment PMI survey. So those sort of indicators have started to move down, and I believe the most recent print was, I think, just under 50, which indicates that more firms are expecting employment slowdowns as opposed to expecting employment to pick up. And so I agree that some of these credit card companies are definitely coming out with other sorts of data, but I believe, for example, Target and Walmart, we're talking about inventory buildup, so there's definitely some sort of a discrepancy there. And I think definitely some part of it has been explained by just above average or above mean or above trend spending post-pandemic.
Yeah, and you could say, I'm obviously on holiday at the moment. You could say that, strong US dollar, more spending on services. There's been that massive switch compared to everyone spending on, durables, to now a lot of it on services. So I guess you could say that's maybe carrying on the economy, whereas
That's
manufacturing, yeah.
definitely some part of it. Exactly. So I think that's definitely some part of it, and just broadly elevated incomes as a whole. So I think that's another important factor that's worth noting.
Yeah, and I think if you look at previous recessions, we've seen what's happened beforehand. Inflation's been running pretty hot. Fed have been increasing interest rates, and then basically something breaks and inflation just crashes, and we sometimes get deflation. So, is that something you're thinking we could see coming? Obviously no time frame, but in the near future, or do you think some people are saying we could keep with 4 or 5% inflation for multiple years. I guess, do you have an opinion on this?
So I think where it becomes interesting is so looking at so keep in mind that so I think we're speaking on the 1st of August, so it's pretty it's August already. And so what is interesting is so I think recently Macro Alf, so Alf on Twitter, so he's a pretty big macro name on he's a very big macro name on Twitter. And so he recently shared a chart where what it showed was so if till the end of the year we saw 0% month-on-month CPI growth, at the end of the year, our year-end CPI is still going to be 6.3% above 2021. And so even if we see that from here we're just going to see 0% month on month, we're still going to end the year with above, so we're with above well, it's drastically above 2%, so it's going to be about 6.3%. So I just pulled up this tweet here, and so where it becomes interesting is so when you consider the dynamics of what would happen in say 18 months from now. So 18 months from now, I think we could 12 to 18 months from now, I think we could definitely see some sort of a different picture when it comes to the inflation numbers. And within the next 12 months or in the next 18 months, I believe a lot could change, just considering that we're sort of seeing a lot of we're seeing in a way a four-pronged tightening approach from in a combination from with the US government in a combination with the Fed. So we're seeing higher interest rates, we're seeing quantitative tightening, we're seeing a higher US dollar, and we're also seeing some level of we're seeing some amount of fiscal drag. And remember that if the US government runs a surplus, that's practically taking money away from the private sector and to an extent away from households as well. And that is potential spending that could have come from both parties. And if we continue to see this sort of four-pronged approach continue, there I think it's very likely that we end up seeing inflation print closer to the 2% number. And where this is interesting is if you look at core CPI, so core CPI has started to roll over and has started to print numbers that are below its high. And this is as opposed to the broad CPI. And the broad CPI, remember, is influenced by food and energy prices. And while those are real costs, those are not the costs that the Fed can control. The Fed cannot magically produce some sort of a refinery in the US just out of nowhere. Or, they can't just magically produce wheat or corn by changing interest rates around. But they can definitely help curb spending, at least in the short run. And we're sort of seeing that with the core CPI numbers, as opposed to the broader CPI numbers. And so what I would argue is we're already starting to see some of these numbers start to slow down. And at least it is my view that this is going to continue into 2023.
Yeah, it's interesting. And then that would be, do you think because the challenge we've seen is the Fed have put the potential for them to pivot. They obviously haven't put in any guidance for the next meetings of saying that they're going meeting by meeting. So do you think if they were to pivot, we could see the opposite happen?
So I don't know if that would necessarily be the case. So for the Fed to pivot, they would want to start seeing inflation actually come under control. And so well again, the core CPI numbers are, and the Fed loves the core numbers, the core CPI, core PCE, etc. While we're starting to see that roll over, I would believe the Fed wants to at least maintain higher, if not hike, rates until we start to see that come down to say come down to say the 3% handle. And where I think it would be interesting is, so if you take, for example, the most recent consumer expectation survey from the University of Michigan, so that has just fallen off a cliff. And consumer expectations and by in a way buying conditions, so conditions for buyers, say within the housing market, that sort of data has just absolutely fallen off a cliff. And it becomes harder for the Fed to revive this sort of an economy, because remember that the problem that we've had ever since we had the great financial crisis up until the pandemic was not that inflation was out of control. It was that the central banks across the world were struggling in order to create higher levels of inflation. And so that's where I think that's what I think the Fed is watching. So one, they would definitely want to start to see some amount of movement lower in the headline numbers, So that would be one, because again, a lot of the media, etc., focuses on the headline numbers. Even if core numbers are coming down, they would want to see that happen with headline numbers as well. And I don't know if the next meeting is too soon for a pivot. I believe it might be too soon, just because we haven't seen the amount of deceleration that would be necessary. But we're already starting to see massive amounts of slowdown. And to your prior question on what's going on with consumer spending. So while consumer spending, at least if you look at the historical data of consumer spending, like PCE, while that is elevated, a lot of the expectations and a lot of the sentiment has actually started to come down, and it's come down in a big way.
Yeah, and it's a challenge, isn't it? As you said, it's trying to understand all these different indicators and actually see, some of them are leading, some of them are just do correlate, but yeah, it's trying to understand what's happening in the markets. And I guess, if you look at, you mentioned there, since the Great Recession in 2008, people have really, well, the economies have really struggled with inflation. Hasn't been much growth either. And some people link that to the secular trend of, I guess, baby boomers. And there's been workers have been continuing to enter the market, continue globalization, all these trends, but we're almost going the opposite way. There's going to be a lot of more people retiring, de-globalisation, securing supply chains. So I'm not sure if you think that massive trend could actually continue inflation for longer term, or do you think that what we're seeing now is just going to just destroy demand? I don't know if you have an opinion on that.
So I think when it comes to globalization and sort of the idea around a trend to deglobalization, so that is inflationary in nature, and in a way it also suits the political climate. It might actually take longer there's the potential for it to take a lot longer, because the process of globalization was again very gradual. So similarly, shifting these supply chains out of, say, China and Vietnam and Russia and Ukraine to, say, the US or Canada or the UK. So I think that would have to be a gradual process. And so where I think it's interesting is, you mentioned the point about demographics, and I think demographics matter a lot. And over the next 10 years, we might start to see the impact of a lot of these slowing demographics. And so within China, for example, so China had their one-child policy, and so now they're seeing a massive deficit when it comes to their population. So their demographics, when it comes to their younger population. So we're starting to see aging population dynamics in China. We're also starting to see, so within China, we're starting to see extreme amounts of control from the CCP. So, we saw the tech regulation, for example, the recent crackdowns in Shanghai, the recent lockdowns in Shanghai. Apple's not been able to get their money out of China for a very long time now. And and on top of that, we're starting to see, what's going on with the real estate market, and the mass amounts of debt that China has just built up within its corporate sector, especially within real estate development, etc. And so, in a way, what ends up happening is it's become very hard to be bullish on China at this juncture. And two, if the deglobal, I honestly don't know if the deglobalization trend actually continues, or whether it's a short-term thing that people are talking about. What we're seeing right now with supply chains. I mean, sure, we're seeing them get disrupted, but then again, remember that the pandemic is really a once in a lifetime event. Though then again, if you have it in hostile countries, there's a chance of, for example, if, let's say, China attacks Taiwan, and the US tries to, or the West broadly tries to help Taiwan, there's a chance that China just shuts out all um all movement of goods through in and out of China, and that would create even bigger problems for the West. And so there's definitely the potential for that trend to continue. I don't know if that will continue, and I think that's something time will tell. But I think that is a trend that is, in a way, obviously inflationary in the long run, and obviously, because producing goods in the US or the UK definitely costs a lot more compared to outsourcing and producing that in China. And so I think that's one. And then two, where it's interesting is, so when you look at demographics, the demographics have been very, very good at just broadly predicting inflation. And We've seen a massive trend of slowing demographics. So within the 1970s, we saw the baby boomers and minorities and women broadly expand the labor force, and now we're seeing the opposite dynamic happen, where when the baby boomers start to retire, one, we're going to see them start to claim their underfunded social security pensions, etc. And and two, what's the other important dynamic there is that the labor force, or the number of people just working within the US, starts to shrink. And obviously, US demographics are still stronger than the rest of the world, but from a rest of the world standpoint, if we continue with the trend of slowing demographics, we're going to likely see inflation also continue to slow down, as opposed to see some sort of a secular increase in inflation, or a secular cycle of higher inflation.
Yeah, and I guess it could become like Japan as long as you can. I think they've seen deflation, but that's a lot of that's been, you could say, because a lot of globalization, a lot of it exporting to China and other countries. So I guess maybe the countries that have very positive demographics, say India, Pakistan, maybe Africa as well, Bangladesh. Those countries could maybe pick up the slack
They
compared to
could,
China,
but then
maybe and
again, the
Vietnam.
broad problems with places like Africa is that they've just not had the type of strong institutions that are present in the US. In the US, for example, if you invest your money in say debt security, there's a very good chance that, or there's say a 99% probability that in the case of default, or in the case of bankruptcy, the commitments of that debt security are going to be honored, because just within a legal framework, a corporation would have to liquidate, and would have in the case of a liquidation or a bankruptcy filing, they would have to pay the debtors first before they pay the equity holders. And so within the US, you would sort of see that kind of a law get enforced, and it's pretty easy to move capital in and out of the US, as opposed to a place like Africa, which has, even though it has these amazing demographics, a lot of the issues in Africa are pretty much just around institutions, and the fact that a lot of these institutions end up being corrupt, or they just don't have the checks and balances that we do in the US. And so we don't have the strong institutions within Africa that would make it attractive for investment. And so that's one. And the prospect of civil wars, etc., and just the fact that they don't have the kind of, so for example, if you look at the US, you can say that, okay, within the last 100 years, it's been very easy to move capital in and out of the US. They have a very strong history of maintaining a lot of these corporate laws, etc. It's a wonderful place to do business. It's a wonderful place to start a business. It's also got great people. It's got et cetera, et cetera. However, if you go to Africa, you just don't have that kind of history, where, in the last 100 years, a lot of Africa over the last 100 years has been filled with disease, war, et cetera. So it's just made it, from a psychological standpoint, as well as from a real, say, institutional standpoint, institutions, state-wise, et cetera, that they just don't have the capabilities that you can find within, say, Singapore or a US or a Canada.
Yeah, and I guess you could say that Ethiopia is a good example. That was one of the fastest growing countries in Africa, doing very well, and then they've had a civil war over the past
Exactly.
6 months to a year. So I guess you could say that's another example of that, and how that occurs. So yeah, but I found it really interesting. You mentioned there that the globalization took 40 years to occur. So as you said, de-globalisation will be, it's not going to
If
happen
it
overnight.
happens as quick as people are saying it, then it's going to be obviously very, very, very inflationary. But again, globalization took a very long time to happen, and it's not easy to move the supply. It's not as easy to move supply chains out of, say, China or Vietnam. Remember that these supply chains are very hard, fixed and set in China, and companies like Apple, being as big as they are, it would take a lot of time to move those out of, build manufacturing plants in the US, and then train workers in the US in order to use those manufacturing plants, etc. So the amount of time it actually takes to move a supply chain from one country to another, it's not as fast as people think it is.
Yeah, and I guess you could say that once the revenues start going down, maybe investors would start rejecting.
That's the other thing. Yeah. Yeah, that's the other thing. And so remember that China has been broadly, so for example, if you wanted to produce something cheap, you would go to China. And so if you want, so Allah say, if a company has positioned itself as just in general as a cheap producer, and it's produced within countries like China, or say Guatemala or Bangladesh, and it produces within those countries just in order to to lower costs and to produce to produce cheaply. If it moves those supply chains to the US, the fact, the way it used to position itself as a low cost provider, that sort of starts to go away as well. And so there's a lot of things that companies would need to consider before one, moving supply chains, and two, again, as I mentioned, the amount of time it actually takes for these supply chains to move. It's not as instant. It can't be done incredibly. It can be done as fast as people are saying it can be done. But if it is done, and if it's done, say, over the next 10 years, that is definitely going to be an inflationary force. That could lead to elevated inflation for a longer period of time.
Yeah, it'll be interesting to see what happens. So, if we maybe go back more to the short term, we mentioned that economic outlook probably doesn't look too good in the US. And if you look at Europe and other countries, it's sort of similar as well. Do you think the markets have sort of priced in this potential risk of recession and slowdowns? We've seen in the past few days, as you mentioned, as we're recording on the 1st of August, we've seen a massive, bull, pushing up probably 10% or so. So I guess, what's your opinion on that? Why do you think this has happened? Why do you think people aren't listening to the risks?
I think the interesting thing is, so I think the thing about equities is I'm honestly not sure what's going on in equities. So there's again the chance that, I know we're speaking on 1st of August, there's a chance that it rallies another 10 to 15% from here, because that's just the way bear markets are. There's again a chance that it sells off another 20 or 30% from here. And that's just the nature of equity markets. It becomes harder to tell, how much has been priced in just directly with equities, just because there's a lot of noise around what's going on with equities. And so, you again have earnings. So we have earnings season going on in the US right now, for example. And so that's another thing that's going to play a larger role when it comes to what goes on within the equity markets. I think when it comes to stuff like fixed income, I would say bonds have started to price in what is going to happen. I don't know if it's entirely priced in. And again, if we start to see if we start to anticipate cuts in the future, then that has totally not been priced in. And so I would argue that within fixed income, there's a potential opportunity being long the long end, so the 10 year to 30 year, or maybe even the belly, so 7 year to 10 year. And I think there's an opportunity there, and so that's so I think that is a potential opportunity when you look at fixed income market. But yeah, as I mentioned, for equities, it's just very confusing as to what's going to happen. And then the other thing is, when you look at markets like FX, say within Europe. So Europe has broadly been hit by higher energy prices and higher food prices. Remember that the EU is a massive importer of energy and food, and not a lot of that is produced domestically. And so, we're starting to see that, and we're starting to see skyrocketing electricity prices within, say, Germany. And so what I would argue is going on in FX is we've definitely seen a lot of that kind of weakness priced in. So higher energy prices, we've seen the euro being sold off massively. So I don't know how much of that, again, when it comes to FX, yeah, we might again start seeing, say, some sort of a divergence in central bank policy. So if the US starts to slow down a lot faster compared to Europe, or if inflation, etc., starts to come down in the US faster compared to Europe, because again, Europe is hit by the Russia-Ukraine war a lot more than the US is. And so if we start to see that there's a potential divergence opportunity where the ECB continues hiking, and the US pauses or starts to cut. But then I think that's a long way out if that ever happens. And we're starting to see something similar in Japan as well. So um, Japan is broadly influenced by commodity imports. And remember that the Japanese economy, really all it does is it imports commodities, produces a lot of these durable goods, say cars or washing machines, TVs, etc., and then exports them out. And so once we start seeing, well, when we saw the recent pullback in oil, so oil, went from basically, say, the mid hundred, the 110s to I think it's back down below 100. I'm not sure, but But when we look at that kind of a dynamic, we're starting to see what's going on. We're starting to see what's going on in Japan. So the Japanese yen sort of benefits from that sort of commodity price slowdown. And so again, a lot of this depends on what happens with commodity prices, which then again is partly dependent on the Russia-Ukraine crisis, and then partly dependent on what goes on with manufacturing and just broad demand in the US, along with other parts of the world.
Yeah, it's amazing how it's all interlinked. Are there any other sort of macro trends that you're watching at the moment, or are they just the main ones?
I think the big way, I mean, these are the main ones. So I would broadly argue that the one that's been the most interesting for me to watch right now has been watching what's going on with economic growth in the US, and so and potential and the possibility of a potential recession. So I think that's interesting to watch. Um, I don't really know. I don't really have much else to watch just right now, just because there's a lot of noise, and I don't think equities are screaming by mm, right now. I would want to see some sort of a shift in what the Fed is doing, because as long as the Fed is tightening liquidity, it becomes very hard to remain long equities. And I mean, obviously, can equities rally say 10 to 15% from here? Absolutely. I think if that ever happens, if that happens, there's definitely a possibility, and that's just characteristic of a lot of these bear markets where you start to see these violent bear market rallies. But do I think that equities are that we're seeing value in equities, and it's like buying, say, Citibank in 2009 in the depths of the financial crisis. I don't think we're at that point yet when it comes to buying a lot of these equities. And I would broadly argue that either that equities probably continue to chop around for a little bit, maybe move a little bit lower. But that remains to be seen.
Yeah, I think it'll be interesting. You mentioned there interest rates going up. That's going to be start costing a lot more, so it might be challenging for especially some of the companies that are struggling. But I guess the risk is that the S&P 500 is really 4 or 5 massive companies that will always make money, even probably in a recession. Like it might not grow,
Exactly.
but I think they'll still make money. So I guess that's the risk. Doing a purely markets play, isn't it?
It is, and so I think that's a good point. So I think about 25%, so about the quarter of the index, is really just the FANG stocks, and I guess FANG and Microsoft together. And so I guess some part of the index just depends on how these stocks do. And if these companies make a lot of money, then we're obviously going to end up seeing we're obviously going to end up seeing the index hold up a little bit better. But again, a lot of the valuations for tech companies has been incredibly stretched and incredibly high. And I think there was a recent piece, I don't remember who published it, but it talked about how the way tech companies use stock-based compensation really hides how much they lose when it comes to their operating margin. So if you look at stock-based compensation, so what you're really doing when it comes to stock-based compensation is, even though it's not a direct cash expense at the time of issuance, so at the time you compensate your executive for a year of hard work, and you give him million shares of stock as his compensation. I think where the issue happens is you fail to account for the fact that in the future there's likely going to be either dilution, which destroys shareholder value. So the company issues new shares in order to make good on the stock-based compensation. So for example, if the executive decides to exercise his options, the company is required to deliver on that options contract, or they would have to have a direct cash expense where they spend cash, buy shares in order to tender them to the executive who got compensated using SBC. And so broadly, what it argued is, if you adjust for stock-based compensation, you really start to see that these operating margins are about 5%, and mean like 5 percentage points. So if you have an operating margin of, say, 10%, your real operating margin is probably 5% after you account for stock-based compensation. And stock-based compensation has been just absolutely insane on a lot of these high-flying tech stock names. And so while the S&P 500 isn't really concentrated with that, it's more Facebook, Amazon, etc. We start to see that a lot of these high-flying tech names, they have these egregious levels of stock-based compensation, and so say at about 30% sales, etc. And I think we would eventually start to see some of that dynamic come down. But broadly, these shares have been trading at these crazy valuations, and a lot of these companies really have no earnings. And one chart that's very interesting to see is if you actually run the Goldman Sachs Unprofitable Tech Index against ARK, so Kathy Wood's ARKK fund, so against the number of shares outstanding in ARKK, you notice that they have almost a 1-to-1 correlation. And I think that's very interesting because it seems that a lot of the dynamic that has been driving these unprofitable tech names has really just been the flow of money into funds like Kathy Woods, which I think has been a big contributor to how much that went up. And so in a way, it has been some sort of a self-reinforcing reflexive loop on that front. But I think I got a little derailed from your initial question there. I'm sorry.
I know that's right. I love it. Just going on these really interesting points. So you think that's, these funds are potentially keeping up these companies, and there could
I
be
think
the risk of.
exactly. So I think there's a very strong possibility that the reason that these funds, the reason that the reason that these unprofitable names, a lot of these, I guess you could call them like garbage tech because they have no earnings. They're trading at these crazy valuations. They're based off of say a 30 times multiple when it comes to price to sales, with and pricing in crazy expectations to what will happen 30 years from now. And the other problem has been that people who've noticed and shorted from a purely valuation standpoint, from a pure valuation standpoint, and you could historically see that the short interest on some of these names has been say 15-20%. And when the shorts cover, that has a material impact on the price of the stock. So you start to see a surge in the price of the stock, for example. And I think so that's broadly where it becomes very interesting. And you start to see these self-reinforcing dynamics where people put money into ARKK because the ARKK has outperformed the market, and ARKK puts money into these shitty tech names, and then shitty tech names go up, and that leads to people see the outperformance of ARK, and it continues in a self-reinforcing fashion where the flows drive the price of the stock, and then the price of the stock or the price of the ETF, and then the price of the ETF drives the flows back in. And that's I think that's really been the dynamic that we've seen play out. And so we're starting to see some amount of that reverse right now. So we're starting to see some of these valuations come back down to earth. And and so obviously within a risk off scenario, within a risk off market regime, we're going to start to see some of these names come down 70 to 80%. And it would be interesting because if some of these names actually end up having value, that would be the time to start looking as to which one of these which one of these high flying tech names actually has actually has value when it comes to a long-term value investment mindset. And so that would be a good time to start doing some digging. But right now what we're really seeing is some of these these extremely stretched valuation that were stratospheric come back down to earth.
Yeah, it's really interesting. So, what do you think the inflection point will be? Do you think it'll be maybe, I guess hedge funds or people who are long these stocks, if they're, as borrowing continues to increase, and if they have heavy losses, do you think that that's, there's going to be liquidations and that could sort of start potential down, or what do you think? Do you think there'll be something like that,
I
or?
think the interesting thing about so I think the interesting thing that what we've really seen is, so in a way you could really classify some of these stocks as growth stocks and really high beta growth stocks. And so they move up very fast, and they're usually very closely related to growth. And so what we've really seen is in many ways, so if you look at the chart of ARKK, the ARK Innovation ETF, what we see is it peaked somewhere around early 2021. And so I think in early 2021, I think the dynamic around growth and inflation started to change a little bit, where we started to see the inflation narrative start to pick up, and the market start to worry about inflation, higher rates, etc. And I think the bigger problem was a potential quantitative tightening, and I think that was another part of what really caused these names to start coming down. And I think so. So I think that's part of what happened. And then the other part has been that yields have started to go through the roof, and typically yields have moved up and down. So over the last 10 years, for example, when we had subdued inflation, the biggest driver of yields was pretty much just growth. And so in a way, the way yields move was just a proxy for what the market expectations for growth were. So if yields went up, we saw that the market was practically expecting growth to go up, and so if yields went down, the market was basically expecting an economic slowdown, because just broadly speaking, inflation had been just under 2% for pretty much all of the last decade, excluding say the 2018 scare. But broadly speaking, when you look at what's going on with a 10-year with the 10-year treasury yield, we saw that every time growth expectations went up, you saw the 10-year yield would go up, and this is prior to the pandemic. And then every time the 10-year yield would go up, we would actually see the tech names. We would actually see that tech had a positive correlation with yields as opposed to a negative one. And I think that dynamic is interesting, if just because typically the consensus view has been that the way yields work is they affect the risk-free rate in the denominator of your the way it actually matters is the denominator of your DCF valuation. So your discount rate goes up, the present value of your cash flows comes down. But I think the argument is twofold. So one, what used to be the prior relationship has broken down. So what used to be before the pandemic was that tech, which was growth, and yields, which were growth as well, they would move almost in tandem with each other. And so that's why that has been one thing that's broken down. And then two, what was interesting is, you had the impact of what were these targeted asset allocation type funds, where they had that we were gonna that they would rebalance based on what their target asset allocation mix was. So if they targeted that that stocks that they would hold say 40% in stocks and like 30% in bonds and 30% miscellaneous. So if your stock holding became 50%, if stocks go up and your holding became 50%, then you would sell your stocks and end up buying bonds. But then we're seeing the opposite dynamic happen. So when when we see the price of bonds come down, so yields go up, bonds come down, so the price of bonds comes down, which means your allocation to stocks is increased. And so in order to return to your intended allocation to stocks, you would have to sell some of your stocks. And so that's the other dynamic that we're seeing when it comes to what's going on with the ARK Innovation ETF.
Yeah, that's really interesting. It's not something that I hadn't thought about before. So, if we look at you, we've mentioned your podcast before. You've sort of, I think it's over 200 interviews with many experts. So, I guess who are the experts that you think people should be listening to? The macro experts.
I think it's a great question. So I think when it comes to who you should be watching, I think the people that I've really liked have been people like Stan Druckenmiller. Every time he got him, he's not been on my podcast. I've not been that lucky.
One day, hopefully, yeah, it's a dream.
Every time he goes on TNBC, it's always very interesting to see how he's thinking through markets. So that's one guy, and then I would recommend Michael Green as well. Just because it's a different outlook away from what the consensus, non-transitory inflation, etc. is. So I think Lacey Hunt is very good at that. So are people like David Rosenberg. So, those would definitely be the people that I would think about. I would follow regularly. And if you want to look at people who've been more on the inflation or the secular inflation side, people like Russell Clark or James Grant have interesting stuff to read because they just bring about a different perspective. But I would argue that those are the people that from at least from a macro expert standpoint or like from a macro commentator standpoint, I think those people are very interesting to follow, and their work is very interesting to read. And in a way, it also provides a balanced outlook. You follow a couple of transitory people, a couple of people who think that inflation is secular, and so you sort of get both sides of what's going on, and that helps make better decisions for your investment portfolio.
Yeah, I think it's so important not just being focused on one side. It's listening to all these different ideas, and then you can decide what you think's right.
Absolutely.
Really. Yeah, perfect. And I guess sort of similar to that, what is the greatest piece of macro advice that you've been given?
That I've been given is it's just to read and learn. It's sort of to read and learn as much as you can, and just about every broad topic you can. So a lot of people tend to sort of just focus on one topic. They're going to become an expert on say interest rates, which is monetary policy, or yeah, or they just don't have the broad. I guess they don't have the broad one. They're not able to connect all the dots because if you know interest rates, but you don't know what's going on in China, you can't really think of if there's any relationship between China and interest rates, if there's any relationship between China and say broader FX markets, etc. So that's one. And then two would be to expand your base of learning. So just the way so don't so there's only so much you can really learn when it comes to economics and finance. And so the other stuff that you can learn, you can definitely focus on stuff like complexity science, and thinking through how the world functions as a big complex system. So thinking through that, learning a little bit of statistics just to understand, if someone publishes a chart and if the chart is actually rubbish, but it looks very interesting because it's like the Fed balance sheet is going up. We're going to see inflation hit like 25% in like a year from now. I think being able to spot those kinds of stupid charts or or as it's called on FinSway, statistical crimes or stack crimes or chart crimes. I think it becomes interesting. I think having that broad-based understanding is very useful. So just being well versed in a lot of different fields and having this broad-based understanding and just also trying to remember that you have in a way you don't really have, I guess, you shouldn't really specialize in one thing. You shouldn't become like a big expert on US agricultural markets. You should have a broader understanding of trying to be a generalist and then try and understand as much as you can about as many different things as you can. And obviously never stop learning, try and learn as much as you can about as many different things as possible.
Yeah, that's great advice. And I know, from my experience, it takes time. So I guess being
It does
patient
take time.
is,
And I think
yeah.
that's where the fun is. So I personally really enjoy reading a lot of different stuff. So it could be like market microstructure, learning about what's going on with say dealer options hedging, or it could be what the US is doing with interest rates, or it could be again, stock-based compensation in tech companies, or it could be, what's going on with debt in China, stuff like that. So
Yeah, you'll always have something new to learn in macro and investing. So Sri, thank you so much for your time. Just my last question, I guess. What is one message you take like listeners to take away from our interview?
oh yeah, listen to market champions. Um, disclaimer.
Shameless plug.
Yeah, no, it would just be just learn as much as you can. So, I think for example, podcasts like yours are a great resource when it comes to learning, and then try and talk to people who are smarter than you and who hold different views compared to you, and then try and I guess come up with a framework on how to think about markets. And I guess writing is very useful in order to like one thing that I like to do is so if I write out an idea, I find that really helps one make it more concrete, and two, if I have any missing holes or if there's any data that I previously didn't consider that might go against my thesis, and I find that to be very useful when it comes to actually laying your ideas out and thinking about whether your thesis or your hypothesis is correct or incorrect. So I think that is definitely something worth trying to do. So just pen it out on a paper, or make it on a Google Doc, or start a blog or something of that sort. So
Yeah, it's so easy these days. Everyone has a Substack or something like that. But as you said, it helps with your own thinking as well.
exactly. Yep.
Yep. Perfect. So Shri, thank you so much for your time. We've
Having me
mentioned
on.
your market champions, which is, a really great podcast which I've really enjoyed. Is there anywhere else people can find your work?
Yeah, appreciate that. So yeah, you can find me on Twitter at SRIVATSPRAKAS8, Srivatsan Prakash. Or you could just type in my full name, Srivatsan Prakash, and you'd find me on Twitter. And presently work as an analyst at Simplify ETFs. And so if you want to learn more about what we do there, you can go to simplify.us. And so I think we've got a lot of interesting stuff going on there as well. So I think that would definitely be worth checking out for listeners as well.
Yeah, awesome. I'll pull that all in the description below. But Shri, thanks again for your time.
Yeah, cheers. Thanks for having me on.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.